Hey! Have you ever watched your trading account go from hero to zero and thought, wait, how bad can this actually get? Well, buckle up because today Dudu teaches you everything about max drawdown rules explained. By the end of this video, you will know exactly what max drawdown is, why it matters more than most traders realize, and how to use it like a pro to protect your hard-earned money. Let's go! Okay, so imagine you are hiking up a beautiful mountain. You start at the bottom, you climb. You reach a nice high peak. Then suddenly, the path goes down. You slip a little, slide a little, and now you are lower than your highest point. That lowest point you hit before you start climbing again. That gap between your peak and your lowest dip. That is your drawdown. And the biggest drop you have ever experienced, that is your max drawdown. Easy peasy. In trading, max drawdown tells you the largest loss your account has suffered from its highest value to its lowest point before recovering. It is not just about one bad trade. It is the total damage during your worst losing streak. Dudu explains, if your account hit $10,000 at its best, then dropped all the way down to $7,000 before bouncing back, your max drawdown is $3,000, which is 30%. Honey, that's how it works. It is one of the most important numbers in all of trading, because it shows you the true risk hiding inside any strategy. Bear with me on this one. Alright, let's make this super real. Say you are trading gold, XAUSD, and you start the month with a $5,000 account. Your first few trades are beautiful. You ride a nice bullish wave, and your account grows to $6,000. Amazing. But then the market flips. Maybe there is a surprise news event, inflation data comes in weird, and gold starts dropping hard. You take 3 losing trades in a row. Your account falls to $4,200. Ouch. So your max drawdown right now is $1,800 from that $6,000 peak. That is a 30% max drawdown. Now here is the key question Dudu wants you to ask yourself. Can your strategy survive a 30% drawdown and still recover? Because if your rules say you stop trading when you lose 20%, then surprise, you already broke your own rule. This is exactly why knowing your max drawdown before it happens is so important. Dudu got you. So how do you actually use max drawdown rules in your trading? First, look at your strategy's historical performance and find the biggest drawdown it ever had. Most trading platforms and backtesting tools show this for you. Write that number down. Second, set your personal max drawdown limit. This is the maximum loss you will allow before you stop trading and review what went wrong. Most professional traders use somewhere between 10 and 20% as their limit. If you hit it, you pause, you breathe, you do not revenge trade. Third, size your positions correctly so that even during a losing streak, you never blow past your limit. This means risking only 1 to 2% of your account on any single trade. Small bets mean small drops, and small drops mean you stay in the game long enough to recover. These 3 steps protect you from the biggest enemy in trading, yourself on a bad day. Okay, now, Dudu's spicy pro tips. Tip 1. A strategy with a smaller max drawdown is often better than one with bigger profits but wild swings. Consistency beats fireworks every single time. Tip 2. Always test your strategy during bad market periods, not just the good ones. Anyone looks like a genius in a bull market. Tip 3. If your max drawdown ever feels emotionally unbearable, it is too big. Lower your position sizes until the losses feel boring. Boring drawdowns mean you will actually follow your rules. Let's go. So to wrap it all up, max drawdown is the biggest peak to valley loss in your trading account. And having clear rules around it is what separates traders who last from traders who disappear. Know your historical drawdown, set your personal limit, and size your trades so you never blow through it. Subscribe to Dudu Trades for more bite-sized trading lessons that actually make sense. See you in the next one.